Hello everyone and welcome to another options trading educational video here from OptionsPath. Today we're going to give a quick introduction to a common and often very profitable options trading income strategy that has a two-step process. And it's all about selling cash secured puts until a stock or ETF is assigned to you, and then selling covered calls against your newly owned shares. Keep in mind that this strategy is only for those options traders who don't mind owning shares outright. I only say this because many options traders never want to actually own any underlying stocks or ETFs, in which case this strategy won't really be suited to you. Now, if you're not familiar with the first step of the strategy, which is selling puts, we have another video where we explained it in detail. The link to that video is in the description below. With that being said, I'd like to first give a quick overview and description of selling puts before we start talking about the second step, which is the selling or writing of covered calls. Okay, so what is put selling in a nutshell? Well, if you don't mind the possibility of owning a stock or ETF at a significantly lower price than it is now, you could sell or short puts below the current price and earn substantial premium income in a relatively short period of time. For this strategy, you would sell puts below the current market price, which are called out-of-the-money puts. When you do this, you earn immediate income through premium that someone else pays to buy the puts from you. You, as the put seller, are obligated to buy the underlying financial instrument from the put buyer if the put buyer chooses. But this only really happens if it makes sense for the put buyer to sell the stock or ETF to you. And that's only if the price of the underlying falls below the put strike price that you agreed upon. The buyer pays a fee called a premium to the seller for the right to put the stock to you if it makes sense for the put buyer. Now, if the stock price ends up above the strike price of your out-of-the-money put by the end or expiration of the trade, you get to keep the premium you earned from the buyer with no further obligation. If the stock price ends up below the strike price of your put by expiration or the end of the trade, you will get assigned, which means you'll actually own shares in the stock or ETF. Now think about this for a second. If you want to own the stock or ETF anyway, then this is by far the best way to do so. You could keep making premium on selling puts on the stock without owning it until such time that one day you get assigned the stock when its price goes below your short put strike price. By then, you'll have likely earned a substantial amount of premium and then finally acquired the stock at a relatively low price or a discount after being assigned. If and when this happens, we can move on to the second step of the strategy, covered calls. To put it simply, covered calls are calls that you sell, which are backed by your ownership of the underlying stock, to earn income in the form of premium from call buyers. As when selling puts, the calls are usually sold out of the money, which in this case means that the strike price of the calls is above the current price of the stock. If the price of the stock stays below the strike price by expiration of the options contract, you will receive the premium without giving up your stock ownership and without any further obligation. But if the stock price ends up above the strike price by expiration, the call buyer will generally exercise the contract and you'll have to sell the stock to the call buyer at the strike price. But you still get to keep the original premium paid to you for selling the covered call. If your stock does not get called away through multiple covered call selling cycles, you get to keep earning premium on a very regular basis. But even when and if it gets called away, you simply sell your stock, often for a profit on that as well, and then begin the two-step income generating process by selling cash secured puts all over again. As you can see by now, this strategy is all about earning income, both before you own any stock or ETF, as well as after you own it. On the way, you'll likely have to own some underlying shares for a while, but for those who don't mind doing so, it can be a great way to establish consistent options income over time. So there you go, just a quick and simple video on one of our favorite options income strategies, selling puts, then covered calls. Hope you found it useful. We'll have plenty more instructional videos on trading options going forward. From all of us at OptionsPath, thank you so much and have a great day.